Will rate cuts in 2026 create a new wave of financial bubbles? Over the past 2 decades, financial markets have gone through the same cycle again and again. In 2000, it was the dot-com bubble. In 2008, the housing bubble. In 2021, the crypto bubble. And today, as the Federal Reserve cuts interest rates to around 3.5%, markets are heating up once more. Valuations are pushing higher, risk appetite is rising, and many investors are starting to ask the same question. Is history repeating itself, or is this time really different? Part 1. Why are rate cuts dangerous? When central banks lower interest rates, borrowing becomes cheaper almost immediately. Companies take on more debt, investors become more willing to take risk, and liquidity starts flowing toward higher risk assets. Stocks, real estate, and crypto all begin to move higher as risk-free returns decline. As yields fall, investors gradually accept risks that no longer match the underlying fundamentals. This is where the real problem begins. When money is abundant and cheap, prices drift away from their true value. Assets start trading far above what their fundamentals justify, and that gap between price and value is what forms a financial bubble. Timing also plays a critical role. After a long period of light monetary policy, markets become starved for liquidity. When policy finally starts to ease, that pent-up demand can rush back into financial markets very quickly, pushing prices higher at an unsustainable pace. What makes this cycle different is the level of global debt. Governments, companies, and households are entering this phase with historically high debt levels. Lower rates may ease short-term pressure, but they also encourage more borrowing and more risk-taking. And that's exactly how bubbles start to form. Part 2. Government debt, the hidden risk. Another major risk, often overlooked, is the size of government debt. Low interest rates make it easier for governments to borrow. But as debt grows, investor confidence can weaken. When that confidence starts to fade, bond yields rise sharply, forcing governments to either cut spending or raise taxes. That kind of fiscal stress can spread quickly through the broader economy. This risk becomes more serious in a low-rate environment because markets tend to underestimate how fast conditions can change once confidence is lost. Part 3. Opportunity or risk for traders. For traders and investors, this environment creates both opportunity and risk. Higher volatility opens the doors for profit, but it also raises the chance of sharp reversals. Financial bubbles don't usually unwind slowly. When they burst, the move is fast and aggressive, and traders who aren't ready get caught on the wrong side. This is why awareness matters. Recognizing early warning signs, maintaining a clear strategy, and avoiding emotional decision-making become essential in this kind of market. If you want to learn how to protect your portfolio against these risks and understand which strategies can work in volatile conditions, stay with us. We'll break these ideas down in more details in upcoming videos. Final question. With all this in mind, the big question going into 26 is where the money moves next. If interest rates fall, which markets do you think capital will rush into first? Share your analysis in the comments below.